everybody. It's Wednesday, July 5th, the day after Independence Day. Hopefully, everybody had a good time and enjoyed some time with family and friends and good cookout. It's good to be back. And just want to give you a brief update. We want to try to get something out to you every week just to let you know what we're doing, what we're thinking. We'll be pretty short today. There's been a couple changes in the portfolio over the last week or so. We want to describe those to you and just tell you about the overall situation, the sentiment, where the markets are and where we think they're going. The biggest thing I want to get out there, though, is that there's this feeling of FOMO, or fear of missing out. The market has really been on a tear since October of last year. And to our belief, this market is still in a bear market rally. I know that nobody knows for sure, but we've just witnessed over the last few years the largest bubble I think we'll ever see, literally the largest bubble that I think we'll ever see. And there's been, just as everyone probably knows, just numerous attempts at intervention, money printing, stimulus. It seems like there's a never-ending list of rabbits that can be pulled out of the hat, never-ending list of magic that can be used to bail out banks, to bail out bad investment decisions made by banks and large corporations. And it feels like this market's bulletproof. And so what we have to deal with, though, is this backdrop of overvaluation, what has felt like almost permanent overvaluation. The market is trading at levels, if you look at market cap divided by GDP, or if you look at the Shiller PE ratio, or the margin adjusted Shiller PE ratio, we're at levels still above the peaks in 1999, 1929, in fact, and certainly 2008. So valuations are a constant headwind here. And we've got the Fed and other central banks continuing to support markets, literally almost saying that they're not allowed to drop or fail. That's the challenging situation, is that we're faced with ever-present crash risk, in our opinion. But the markets still continue to go up in the short term. I might point out that we're still below the all-time high on January 4th of 2022, a good 8% below that high on the S&P, but it feels interminable, the topping process that we're going through. And we don't know for sure that it's a top, but everything else that we know in our experience, that we know in our bones, makes it feel like it is. So fear of missing out is definitely back. Let me share some slides here with you. This is a recent Barron's cover. The market has legs. Whenever you see plastered all over current news periodicals, the fact that the bull market is back, or the market has legs, it should at least give you some cause for pause. I know it's a contrarian indicator, and contrarian indicators aren't really good at predicting timing. We'll fully admit that, but this is definitely a warning sign. If you couple this with record individual advisor bullishness and investment advisor bullishness, I don't have charts for those this week, but suffice it to say that those levels of bullishness, a daily sentiment indicator, is off the charts as well. All of these things give us reason to be very cautious. Now, that doesn't mean that we can't do anything. We're only about 5% net long right now. That means we only have about 5% exposure to the broad market. If you don't include gold miners in that calculation, if you include gold miners, it's closer to 15%. But still, we're very, very lightly exposed to the market on a net basis, and that's because we think there's significant crash risk. Breadth has been very, very weak over the last 6 months. It's getting a little bit better, but mostly this market has been carried by just a handful of tech names. And that's another thing. Whenever the market has when you notice that there's a speculative part of the market leading and the rest of it is staying relatively flat, it's cause for concern. The Dow, for the most part, hasn't participated. The NASDAQ is up 30-something%. The S&P is up 15%. And the Dow is up much less than that. And so it's a very narrow market. We've got our eyes on all different sectors looking for opportunities, because we want to be able to take advantage of opportunities when they come, but it's difficult because we face this ever-present crash risk. One of the things that we do every week when we look at our main indicators is to take a look at individual sectors. Our main indicators did reverse up about a month or so ago, telling us that This market has some bullish underpinnings. However, the breadth is very, very weak, and we've been having trouble finding good charts. One that we did find, in fact, probably the best chart that we see, besides gold and other precious metals, is industrials. So I'll share that in just a minute. I'll actually get to that in a minute. First, I want to show you, further to my point about rallies and fear of missing out in bear markets. This is just one example. In the 2000-2002 bear market, there was 4 different instances of greater than 20% rallies. And so it's just be careful about fear of missing out. It can lead you to make bad decisions. I think one of the biggest things we do for clients is to act as a filter for psychology. We deal with the emotions and the psychology, hopefully so that you can do so less. I know it's still very difficult to disengage, particularly when it seems like the market's going up and everyone's talking about it. But here's industrials that I just mentioned. This is a point and figure chart. We use these often. These are the same as bar charts, but they tend to compress time. What we're looking for in a sector is we're looking for it to outperform other sectors on a relative basis, and we're looking for a very good chart pattern. So one that continues to come up on our screens over the last few weeks is industrials, broad industrials. Even though the Dow hasn't participated much, and many of these stocks are in the Dow, this group, XLI for industrials, has a long basing pattern over a couple of years, and then completed what we would call a spread triple top here. So this point here exceeded the previous 2 tops. In fact, we've exceeded all of these as well. So this chart is almost picture perfect for the type of thing we're looking for. And so because our short-term indicators reversed up, even despite our bigger picture concerns, we did put on a position here in industrials. We put on a 5% position, not a big position. We just want to get a starter position in place because we're very concerned that this bear market rally, this second wave rally that we would also call it, is topping out. We don't want to add net new exposure to the market. So what we did in this case is we paired it with an equal position, 5% short the NASDAQ, with a non-levered exchange traded fund. You want to stay away from leveraged ETFs, in our opinion, because they can introduce additional tracking risk. But we put on a 5% position in XLI, coupled with a 5% short position in the NASDAQ. Take a look at the NASDAQ. This is a very strong chart, but it is what we call up on a stem. There's been no consolidation. It's been a straight up move year to date. I mentioned a minute ago, the NASDAQ's up 36%. And there's been literally no consolidation. There's no clear stop unless you go all the way back down to the bottom of this pattern. And it's our belief that this thin market or this speculative fervor is indicative of a topping process in this second wave rally, this bear market rally, which is what we think it is. So we put on a 5% position short here, 5% long industrials. This doesn't increase our net exposure. And our hope is that if the market continues going up, industrials will outperform the NASDAQ, or if the market rolls over and drops hard, that the NASDAQ will drop more than industrials. Then we can take off the hedge in the NASDAQ and leave the industrials. In short, we've got a lot of different options at that point. I want to talk about gold and silver here for a minute, because gold in particular has outperformed even the broad stock market since the year 2000. Yet it's been a pretty, it's kind of a pretty boring topic. People don't like to hold it. Oftentimes it's said that it doesn't pay dividends, or some have called it a pet rock, but really it's one of the best charts out there, other than what I just showed you a minute ago, industrials. Here's a chart of gold on a monthly basis. Gold has produced this huge cup and handle formation. This goes back to 2011, the prior bull market high, and then it went through almost 10 years of consolidation. The drop back here through the 2013, 2018, 19 timeframe was a minus 40% bear market. It was very painful. But gold carved out the right hand of this cup. It created a handle, a triangle, and a bigger pattern that I know looks a little bit messy on the surface, but ultimately it created this triple top. Now, bears might look at this and say, well, it's a triple top. This is, not going to break out. It's going to come back down. And granted, nobody knows for sure, but triple tops generally are broken. And we've got a couple months of consolidation here at about 1930 or so on gold right now. It's our view that gold is going to break through that pattern. And once it does, a measured move should take it to around 2,500. So we don't have any guarantees about the future, but this is one of the better looking charts out there, which is why we have a position in gold miners, a 10% hedge position in gold miners. And we also think that people should hold 5 to 10% of their investable assets in physical gold and or silver. The silver chart is a little more extreme on the upside and on the pullback, but over the same time frame, silver has been creating this consolidation pattern that broke out a couple months ago and has now come back down to test that trend line. I believe that silver will also break higher and move into the 30s when gold goes towards 2,500 or so. Just wanted to give you a quick update. We promise to continue to try to do these to let you know what changes we do each week. I know a lot of you want to understand our thinking, and we'll probably do some more videos with more in-depth talk about how we make our decisions, how we look at things. But we definitely have a bias that this is probably a bear market rally that's going to top out soon based on sentiment, based on the fact that the market is still thin and the speculative names are leading this rally. So don't worry about it. Try not to have FOMO or fear of missing out. When you see Barron's covers coming out saying, well, we're 20% off the low, the bear market's going to keep going higher. Nobody knows. History tells us that that's probably not going to be the case. And we want you to know that we're looking as hard as we can to find good looking charts and strong sectors so we can add additional exposure. We still maintain a lot of cash, somewhere around 35% cash equivalents at the moment. So we have plenty of dry powder to take advantage when there's a good opportunity. Right now, though, there doesn't seem to be any worry in the market, and I believe that's going to be short-lived. We'll see. So thanks for listening, and thanks for tuning in. We'll continue to update you each week. It would be great if you would subscribe to our channel. We don't have a lot of subscribers yet. We're trying to get some momentum and get some information out to you. If you could subscribe to our channel and like the video, we would greatly appreciate it. As always, if you have any questions, reach out to us. One of us will be happy to jump on the phone or a video call with you. Always looking forward to connecting with you. And for now, until next time, thank you very much for tuning in. See you soon.